The Reserve Bank has stood its ground on interest rates once again, much to the dismay of industry. The union budget, though, is now just more than 50 days away. Rate cut aside, the list of demands from India Inc. are long as usual. So today, the finance minister met with top corporate leaders from key industry bodies like CII, FICCI, ASSOCHAM, among others. This is the second day of the pre-budget consultations. Yesterday, agriculture and farm sector representatives kicked off the budget talks. So what does industry want? Top of the list is a cut in corporate tax rate. CII is pitching for a dramatic cut in the headline rate to 18% to spur investments for the private sector. Both industry bodies, whether it's CII or FICCI, believe a cut in corporate tax rate is warranted to improve India's competitiveness. The effective corporate tax rate in India is above 35%. And with Donald Trump planning to cut the corporate tax rate in the US to as low as 20%, India Inc. believes the time to act is now. Government sources tell CNBC TV18 the government is committed to reducing the corporate tax rate to 25% as was promised. In fact, sources tell us that the glide path to 25% may be much more clearly articulated in the upcoming budget. This issue aside, industry is also seeking a slew of changes, especially in the power and banking sector, to spur growth. Joining us to discuss all of this, the two heads of the two industry bodies, Shobana Kamineni, the president of the Confederation of Indian Industry, or CII, and Pankaj Patel, the president of FICCI. Shobana and Mr. Patel, thanks very much for joining us. Let me start by getting your reactions on the credit policy. It's a status quo policy. That is what the market was expecting. But Shobana, when we spoke around the credit policy time a few months ago, the clamor from industry was 100 basis points, 200 basis points, that it had to be done now. But given the fact that there is some improvement as far as the overall economy is concerned, credit growth has also seen an uptick. Is this now a little lower on your list of demands?
I think that especially today that we were completely focused on the budget, and many a time, actually all the press came and asked us, it's a continuing demand. It's a continuing, not really a demand, but I think it's a continuing necessity that we don't forget that good interest rates are required for industry to do better. We have to remember that we're just at 6.3 in the last quarter. So for us to move up, interest rates will always be an imperative. So we are disappointed.
Okay, Pankaj Patel, you are disappointed, as was expected. Pankaj Patel, but let's also keep the reality of how the Reserve Bank is viewing inflation. It has upped its forecast for inflation, saying that food, fuel, it expects the pressures from there to weigh on the inflation trajectory. It's also talking about the rise in input costs and how that could be translated to higher prices at the level of the consumer. What is the feedback that you're getting from your members in terms of the rise in input costs, and whether we are likely to see price increases being passed on to the consumer as well on account of that?
So I think first of all, let me talk about the interest rate, and I think we are disappointed that there is no cut in the interest rate. When the economy started going a sign of improvement, a boost in further with an interest rate cut would have definitely added some further sentiment and also would have made it possible to actually see even further higher growth. Currently, I'm not hearing too much about these increase in the input cost from my members. Though there is globally the commodity prices are firming up and oil price are firming, but India, that impact has not yet passed on to us. So today we don't see it. But as the commodity prices are firming up globally, we will see that impacting maybe after 3 or 4 months.
Okay, let me then talk to you about the list of demands that you've presented to the finance minister, and I'll start with the reduction that you want as far as the corporate tax rate is concerned. CII has presented a very dramatic scenario for the government. You're asking for a cut down to 18%. Shobana Kamineni, is that a realistic expectation? The government promised 25%. We still haven't been able to see 25% for all of India Inc. Do you really realistically believe, given the revenue implications, an 18% headline rate is possible?
Shireen, many of us didn't believe in so many of the things that the government did, including demonetization, but they did it because it had a big impact. And I think that and if you really look at the world today, The interest rate that the corporate tax rate we're asking for is not excessive. In fact, it's in the ballpark. The US last Saturday is passing sweeping reforms. England is committed to moving their tax rate from 20 to 17%. Singapore already has it. Even on the developing economies around us, all of them have competitive corporate tax rates. India is among the highest. And again, the math of what we're asking for is make it simple. Here we are saying that remove every one of the concessions you're giving us. Remove the cesses, remove everything, and keep it simple so that everyone understands, level playing field. More than anything else, why I believe that the time for this idea has come is because with GST, 1.2 crore people have registered, companies have registered, and only 400,000 of them are actually tax paying. So when you have a wider tax base, the math really presents itself to do something to do something bold and decisive.
Bold and dramatic. Mr. Patel, would you agree with Shobana Kamineni that nothing is impossible? If the government could do demonetization, it could bring down corporate tax rates to 18% if it so desires. But let me ask you, sir, FICCI hasn't put down a number. You've basically said that the government must conform to what it committed to, which was 25% across the board for India Inc. as the headline corporate tax rate. Do you believe realistically we could see that in the upcoming budget?
So a couple of points, let me tell you that what we have said in our presentation is saying that the global scenario is rapidly changing. If India has to remain competitive in the world and attract investment in India, if our tax regime is not going to be friendly, then we are going to see that investment going to the other territories and not coming to India. So that's not only for foreign investment, but even Indian companies investing in India may also look at other territories where tax rates are lower. Given that the challenges we have, we need to really attract India, make India more attractive. So I'm supportive of 18%, but the question, what we have said is that you have already promised us 25%. Please do that at least.
25%, What was the response? What was the response from the finance minister today? What was the response from the finance minister on this specific request today?
He did not respond to anything. He just listened to us.
He was very mature.
Just listened.
They were very mature that they had.
Go ahead, Shobana.
That this was a thing. I agree with Pankaj that they had called us for our interventions, and this is stage one. We're just entering into the development for the budget, which we're 5 weeks away, and all the industry associations are on the same page with regard to corporate taxes.
Okay, let me then ask you about the third demand, and that has to do with the GST. And here again, there is convergence between what CII and FICCI are demanding. You're saying that we should come down to a 3-rate GST tax structure, which the finance minister here on CNBC TV18 has also articulated is the intent, eventual intent of the government. Outside of that, on the issue of anti-profiteering, because I know that FICCI has raised this as a cause of concern, Mr. Patel, you asked for more clarity on the anti-profiteering mechanism and how it's going to work. How worried is industry on account of this?
So the issue is really that, you know, when GST came in, number of taxes have been subsumed into this, that. And as a result, you know, if you are a national player, you have tax of 5% in one state, another state would have a 10%, the third state would have 12%. You might have a local levy of octroi in some state it may not have that, somewhere there is entry tax, and so forth. So given that, it's become a very complex calculations, and this could be always a kind of a dispute which can arise later on. So that's why we said, let there be a clear clarification and ambiguity is removed as much as possible, so that the industry does not face later on problems, and industry will be able to do truthfully the difference in the tax, if at all there is will pass on to consumer, and do not get into the net of the anti-profiteering.
Okay, I would imagine that, Shobana, that's CII's point of view as well. I want to then end by asking both of you, because both FICCI as well as CII talk about the need for more expenditure, productive expenditure, and you do say that even if that means a relaxation on the fiscal deficit number of 3.2%, so be it. Shobana, is that CII's position as well? Because that is FICCI's position, that even if 3.2 becomes 3.5%, if it's productive expenditure, so be it.
So we did not take up that issue. I think that we were more pointed in giving certain solutions, especially with regard to bank recapitalization, the bonds. We think this can be reissued, and there's an opportunity to create another 1.35 lakh crores in banks, because there's an appetite for these bonds to be sold to institutional investors. Then we said bring down that equity to 52%, then 33, again another opportunity. Then we spoke actually about a power, the stressed and stranded assets. If you can create a national power development corporation where you bring in all this, sell power, you're going to create a transparent, simplistic pricing also for power. Then after that, we really went into another bold, that we said, you know, that the land that is lying with government, with the army, with the railways and other central government organizations, put it into a central pool called the Land Bank Corporation, so that these are prime areas that industry can actually, you know, what we require is land to set up industries. Then of course the infrastructure areas of healthcare, of education, an innovation fund taken out of the technology cess. If we can do this, we also said use blockchain technology to start into the analytics of our income tax. So we went into many of these areas that were actually solution providing to be able to kickstart, create more jobs and investments that are required.
Okay, let me end then by asking the two of you, and Pankaj Patel, let me ask you, both CII as well as FICCI do dipstick surveys of their members. What is the sense that you're getting? We heard from the Reserve Bank Governor today saying that there has been an uptick in terms of credit growth. In terms of capex, what can we now realistically expect as we close this calendar year and start a fresh one?
So I think we clearly see there the growth picking up, and the growth picking up, also seeing manufacturing sector activity going up. Some of the sectors are doing extremely well, and we expect more investment to happen on those sectors. You see some of these appearing in newspaper also now. So I think the mood is upbeat, and people are looking at opportunities going forward. At this moment, as I said again, interest rate cut would have been a great booster to this. With respect to the infrastructure investment, which you just mentioned before, what we are trying to say is that the government has put a lot of thrust on infrastructure investment in India, and that resource that has helped us to grow the economy with the government. We said that further investment with even higher number should go. If that will call for even some adjustment in the fiscal deficit number, we are okay with it, but because that is going to ultimately bring growth. And once the growth will happen, the revenue will come up, and then the deficit will be anyhow taken care of in time to come. So that is what we are trying to say it. Couple of points we also raised, important points we raised is, one is that export is very important, and the export zones should be created. Our SEZ policy has not delivered what it was expected to, because it again was taxed. We said hassle-free, tax-free, regulation-free zones for export should be created, and we should invite exporters to come in. Technology will come in, employment will happen, and that will help our country overall. We also talk about innovation, and we said support to innovation is going to be key to get success in employment. And we also made several other suggestions.
Well, a long list there. Yes, several other suggestions. I'll end with you, Shobana Kamineni. FICCI saying the mood is upbeat. Is that what is being reflected in the CII dipstick survey as well?
We've done ASCON and CII and we've got more than 300,000 companies. Auto is doing extremely well, and all the ancillaries around it, the upstream, we're finding an increase even in steel. So we had always maintained that capacities are going to start being added, if not early next fiscal. By Q4, I'm completely optimistic that by Q4 you're going to start seeing that needle move in capital goods, consumer goods, and also in some of the basic goods industries. Construction equipment is doing extremely well, where we've actually grown 35% in the airline industry. So all around, we're seeing there is some amount of uptick, but this is the time that the government really needs to act. That and Shireen, we're not demanding, but what we think is this is the time for everyone to act.
This is the time to act. That's the word in from industry before India starts to lose out on its competitive advantage, especially when it comes to corporate taxes. Cut now. That's the message from corporate India to Finance Minister Arun Jaitley. Shobana Kamineni Pankaj Patel, thanks very much for joining us here on CNBC TV18.